Thank you very much. I really do appreciate it, and I appreciate the Export Academy for hosting Valufin in what will hopefully be a long-term relationship together. Foreign exchange is something that we get involved in, many of us, whenever we are importing or exporting within our businesses, whether that is product or whether that is services. The foreign exchange I'm referring to and that I'm going to be talking about now is about that relates to the business that is importing and exporting. We're not talking about investments or fund management or bank side of the foreign exchange element. We're talking about why is it important to the trading entity in a country trading with another country. So just make sure that we keep it in that context. Obviously, if people want to know anything about other elements that I'm now not going to be covering, please by all means make contact via the mechanisms that have just been shared with you. For an importing and exporting company, foreign exchange is probably one of the most complex, most profit influencing elements of the foreign exchange transaction that is occurring, of the trade. Yes, you've got licenses, you've got excise duties, you've got shipping costs, you've got supplier costs, you've got all the elements of supply chain management. And you've got to then take the other side of it, pricing to a customer, customers paying you late, credit terms, all the things that we're going to cover very briefly in a moment. But it's the element of foreign exchange can have a profit and loss impact far greater than getting those other things wrong by getting the foreign exchange wrong. And most people think that we can just go to our bank and that we can just handle things at the bank. So that doesn't work. And the reason that doesn't work is because bankers are not in your seat. They're not in your chair. They're not doing your day job. They're doing banking. Banking is providing you currency at a price. That's what bankers do, providing you another instrument, another structure, a different price, absolutely, but they're still only offering you the currency. So what we are looking at, and the reason why everything is so interconnected, is because you are unique in your industry, you're unique as a company, you're unique in terms of your risk strategy, all the elements that make your company specific and therefore needs to be approached in a fashion that addresses the specific nuances of your supply chain, your credit terms, your cash liquidity, your risk profiling. All of those things need to be considered whenever you are looking at your business. You also have different currency pairs, different countries, different systems. And there isn't training out there. This is one of the few places you're likely to get any training in a foreign exchange environment. So if you look at the situation of a chartered accountant or accountant, bookkeepers, debtors clerks, people who've come through the finance element of a business through experience, through whatever mechanism they have come, very seldom are you going to come across the training we're going to cover today. So it is important to, like you would use consultants to do your HR, consultants to do your legal. This is where foreign exchange comes in, is using a consultant to do the best for you with your interest at heart and the knowledge of you as a company at heart, which is why we always have specialists in our various business environments to support us as companies to make sure that we do the best we possibly can. And within this environment of foreign exchange, the part that makes it so complex is you're constantly having to make decisions. And these decisions are impactful on the business's profitability, and they have to be made now. And that's the problem you have with foreign exchange. Markets move. We've had interest rate movements. For example, today, the Bank of England has left their interest rates unchanged, but Europe, the EU, upped theirs last week. Dropped theirs by a large amount last week, unexpectedly. The US have dropped their interest rates yesterday, also by a higher margin, and then the UK doesn't drop theirs at all. So you've got those kind of things. Now, that has happened just in the last probably less than 12 working hours that we've had the last two interest rate movements. So what does that mean to your business? What does that mean to the products you've got? What does it mean to the payments that are due? What are you going to do about the fact that this has just happened, and how are the markets responding? So those are when you come to the situation that decisions have to be made pretty quickly if you're going to take advantage of a movement that has occurred. Markets are volatile. Today, this last week, we've seen a fair large amount of volatility. Everyone says, oh, well, this market's more volatile than ever. I've been in the markets for going on 40 years. They're volatile, full stop. It's just the range trading that changes. Are they in a wider range, narrower range? So markets are constantly moving. And even if it only moves 2%, 2% of your product cost could be a massive amount of your profit margin. So we do have to take this aspect seriously. If I look at foreign exchange and I try and understand how can we make this able to be assimilated by somebody who needs to understand the influence this has on the business. So I put my mind to plan a little while ago and thought we need to create structure to this complexity. And structure, one of the ways you can create structure is to create a mnemonic, a word. And through that word, you create order. So what we did is we created a framework around the name of the company, Valufin. So we have now got a mnemonic of Valufin, and we're going to spend the next half an hour just running through very quickly at a very high level what each of those letters stand for within your global trade environment. We do have individual courses that look at each letter, but today we're looking at the entire Valufin framework. And this allows us to pick up a lot of complexity in a structured format. So we're going to value, assess, learn, understand, find, internalize, and look at what is new. So those are the things that we're going to cover in the next very short while at a high level. Hopefully you'll have more questions left at the end of this because we have addressed it very quickly and at a very strategic level rather than a detailed operational level, which is obviously available. So under the Valufin area, we're going to look at strategy. So value is what is built. We get value by building upon sound foreign exchange foundations and making sure that we have got our strategy in place, we've got our risk appetite in place, we've got our policies and procedures in place, and we know how we're going to go about managing our foreign exchange. Working with a company not so long ago, they had put in so many processes and policies and procedures and steps that they were putting in days of delay into the process. They were creating all sorts of opportunities for risk to filter in because they'd actually overdone the policy side of it. And they ended up, as a result of that, certain salespeople within the organization got frustrated and were bypassing the systems and processes, giving them a double risk area. So it's getting that balance and not over-engineering things. Making sure that within the structure of the organization, we have the right people, having the right information, the ability to make the correct decisions that they need to make very quickly and in a manner that is effective for the business and the risk the business has. Probably you have with the bank, you say your bank looks after you. Yes, interest rates move, they phone you. But is it relevant that they phone you? Do you need to know that right now? Or is it so highly critical you needed to know 5 seconds ago? And the bank is not able to judge that, but you are able to. And it's making sure you understand the immediacy of what information you need. Otherwise, the overload will crowd it out to the point that you won't even have a day job. All you're going to be doing is listening to the noise. So what we're going to do is make sure that we create what is important for you as a business to know, to create value in the foreign exchange risk management area of your company. We're now going to look at assess. We're going to assess where the business is at this point in time. What are we doing? Are we importing? Are we exporting? Do we have long lead cycles? Do we have short credit terms? What are the variations that might occur? Does it happen, like, for example, one of my customers will get product out of China and he has absolutely no idea what his shipping might be because it just gets onto the next ship that's available. There's no plan that it's going to go on this ship in this place on that day and it's named that, and therefore they get it and the letters of credit follow. So others might have exactly very, very strong shipping cycles. But what happens when there's a tsunami in the China seas and you find that everything is disrupted for 3 weeks, if you're lucky, or there's a COVID, things like that that cause disruption to something that is known. You have seasons. We have customers that do a lot of agricultural products. Some seasons are very, very sensitive to weather. Some products are all year, or they can store the product for 6 months and then release it slowly into the market. So there's very different markets into which you are selling into or buying from that cause a lot of variation and seasons to your business. The other situation is liquidity. You might be fairly tight on liquidity and going into debtors financing or having to borrow or having to fund certain supply chain projects, getting credit from your supplier. How are you managing that liquidity element? How are you pricing that into the customer and making sure that you then know what is the foreign exchange implication of the various risks that you have as a business when you are dealing with foreign exchange? Now that we've assessed the business, we need to learn about what do all those things in the business mean. So what I've talked about, order cycles. So what? So what's the so what that we need to learn about? So we need to learn about how all the elements we've already started learning about are going to impact the business. We're going to have different markets. So whether we have a volatile market, we have a volatile currency pair, we've got different ways in which we might be able to hedge. We're looking at different instruments we might be able to use, but also we're looking at when we do use things or use product or use spot or work with a bank A or a bank B or a broker, how are those different suppliers of my currency alone going to impact my liquidity? And it's massive. So it's not because I just buy currency, I just buy currency. It doesn't work like that because you've got a forward contract and there are different ways in which you can utilize any of your instruments. And even something as simple as spot can have anything up to a 2-day variation in the way you can deal with it. And that has a major impact on your credit line, headroom on your facilities, cash flow going through your bank account, and therefore your liquidity and your local currency management. So it all comes through in a circuitous cycle and is impacting you. And it's something you need to be able to understand, plot, and be prepared for. And because markets are volatile and today is based on today's market price, you have some aspects on which you have no control, but you need to have the understanding of the variation of how that can impact your facilities and your cash flow and your liquidity. One of the areas in foreign exchange that I know from my 40 years of experience in foreign exchange that is not done properly, and that is the accounting for foreign exchange. So when somebody says to me, we always make a profit, I don't believe them. When they say we always make a loss, I equally don't believe them. Foreign exchange accounting is complex. It involves anything up to 3+ entry cycles that might go through your bank account to actually determine what the true cost or income was of a foreign exchange deal, invoice paid, or money earned for having invoiced a customer. So there are so many points at which just the foreign exchange element are going to impact your bank account. Least of all, tying that to the invoice, the goods, and therefore the genuine profit and loss on doing business rather than profit loss on a foreign exchange element of doing business, which is only half the equation. Making sure that therefore companies know what's in the balance sheet, what's in the income statement, what is real and what is the timing difference. And getting to understand how those go through the balance sheet and income statement are highly critical and highly important for the business to make sure you understand that. Another massive complication that comes into it, and this is because I'm an accountant, but accountants get in the way. Accountants try and process things through accounting systems so that they can be readily understood. But by doing accounting, we have 2 things that impact our foreign exchange element of this. Month ends, we close things off and we put a line under them. That impacts the way we handle our foreign exchange accounting and therefore knowing what is the true truth. The other big one is year end. And year end has a huge impact on profitability, balance sheet, credit lines, facilities, depending on how the foreign exchange element of it impacts the balance sheet and the use of facilities. And year ends do not underestimate how they can impact you, and therefore how investors, for example, might view your balance sheet. So it's knowing what those are and managing them for the business, not for the accounting thereof, and knowing what those two stories are and how different they do look. We then need to understand what actually are we doing in the foreign exchange space as a business. So what is the business forex element? What are we doing that we are going there out into the market and understanding how are our exports and imports, the movement of goods and services, impacting our business? So we buy or sell something at source, and we invariably either use that in manufacturing, or we sell on or buy from the second part of the equation. So there are incoming, we have it moving to us, reaching us, flow of information, transfer of risk. At what point do funds move? What point does risk move? And then making sure we've got the accounting of all these elements correct, and we've processed it through our books early enough, identified risk early enough, and making sure that we then got the pricing to the customer, product pricing, a base understanding of what's going through the ledger correctly, and then ultimately putting all of that together and saying, with this information, I now need to make foreign exchange decisions so that I can secure profit. Spoke to a customer yesterday, and they said, we've just ended up with a situation where, because they didn't think to hedge a currency risk, they've ended up with an additional cost that works out at something like 25% of the price of the original price. So a movement of sterling from 128 to 133, where it was the other day, had a 25% impact on their profitability and the outcome to the business. It is significant. And that is something that occurred in a period of 2 weeks. So it can be absolutely significant, the way it can impact the business. And that is purely because nobody thought about it at the time that this was something that is a risk. So the importance we have as a provider to our customers is to be integrated into the customer, because invariably we see the information. The customer may not have thought of telling us about the information. So it's making sure that whenever you have foreign exchange, you can't rely on a bank to know that information, because they don't see inside your business. Whereas your treasury manager, somebody who is the currency expert in your company, is living alongside your management and is working with the management, with the business, with the strategy, with the growth profiling, with the importing and exporting, sales and purchase departments, understanding what the business is actually doing. In this particular example, the business did something that was completely out of the norm of their business trade, and therefore the whole framework didn't work in terms of talking about, actually, we've got a risk that we didn't even know we had. And this was all done at strategic business level, at board level. And there, the board itself became a risk to the organization by not sharing it into the correct places such that the finance person would have picked it up. So we always saying to the customer, Forex is hidden in every little corner. It's like mercury. It runs into corners. Let's see if we can go and understand that and make sure at all times we are looking out for the company and for our customers. And quite often when customers are saying, well, I don't have information, I'm waiting for my forecast figures, we're having to operate in an absolute vacuum, not knowing what kind of business flows we're expecting from the customer. But because of the data we've held for the customer for years and years and years, we are in an ability to say, unless you've got a completely different business cycle, we've got some idea of whether September is typically a higher volume month than August. And if so, let's be mindful of that, even though we have limited information. So we can actually think for our customers because of the fact we have data. It's really important to have that information. So now we're going to go and find out more information from within the business. So the As a treasury manager, I've now got from everybody the learning, the understanding. So I've assessed the business, I've learned about the products in the market, I've understand the impact of the business upon the company's P&L, on their volumes, on their market share, their competitive space. I understand all of that. So now what I've got to do is go and find in the market solutions to my problems. So my requirements might be, I've got something coming up next week. I've got samples coming out from China for a new product range. I'm selling to a customer in the US on something else, and I'm shipping some raw product in to go into one of my manufacturing processes. These are all happening in businesses all the time. So I need to manage that portfolio of information, which requires technology, an information system. Now, this could be your ordering system, sales system. It could be integrated into your accounting system or standalone. And then we work with APIs to get that information into our environment so that we can bring it into something that's understandable in forex terms. Because quite often, the important thing is knowing that if you're going to be ordering from, let's say we're bringing something in from Europe, and we know that there is a decent credit limit on this. So even though the goods are arriving in store tomorrow, I know I only have to pay for it in 90 days, but I'm selling it to the customer in 30 days. So everything's the wrong way around. How am I going to manage that, for example? So we look at how we're going to hedge that. Where is the risk between pricing to in the case of an import and a sale? Where have my pricing points been on the currency? At what point have I transferred risk? At what point have I put myself into a time window that I now need to look at making sure I hedge in it? Because if I don't, I'm actually going to cost myself more. How much cover do I want to take? Do I want to make a 100% yes decision or a 100% no decision? And what is a difficult concept for many finance people and people in the foreign exchange space, risk departments and risk committees at board level, is if you take 100% cover, you have removed any opportunity to manage the change that is going to occur in this window of time. If I take no cover until the end, I've effectively taken the exact opposite risk, which is also still 100% risk, because I'm open to anything happening. And meantime, I've priced and sold the product to the customer. So 100% of either everything or 100% of nothing are both risks to the business, and the business needs to find a place in between. And the place in between is that unique thing I spoke about in the triangle right at the beginning. That uniqueness is making sure that we understand for the business how much cover it should be taking. Where am I in the sales cycle of all the things happening in my subsidiary operations and everything that the business collectively is doing? Where is my risk element this month relative to next month, where I could get a very, very different answer as to how much cover I need to have in place to ensure that I've protected a known situation. So companies can go cover from anything from 10 to 80% of the ranges. You will see that you can put a horse and cart through that. But what we're saying to companies is typically based on credit terms. If you're on 90 days, typically on average, ensure you've got about 90 days worth of cover. If you're sitting on a just-in-time basis, you can go for as little as 1 week being your window. Other times, you could have anything up to 9 months. The longest I think I've ever worked with a customer was a company in satellites, and we were dealing with a 15-year window all the time. That was probably one of the most challenging. How do you hedge something that is 15 years out? And there's an interest rate cost, which is what builds into your protection to actually price it out the market. So you have to have an element of risk. Very different strategy to somebody who's working on a rolling 90 days. There are different instruments we can use. They're regulated in different ways. They behave in different ways. They respond to volatility in different ways. And there are certain products that can have a really nasty kick in them. And the way they are structured these days in complex derivative natures in certain cases, they can be extremely damaging. The other element is we end up with being sold to us the simplicity of a new structure, which has got oodles of percentage cost built into them. They are not good either. So we come back to the vanilla market, which is your spot and your vanilla fixed forward, as being the instruments that, if used correctly, you can create a portfolio management structure without having to deal with complex instruments that can be very damaging. That's not to say derivatives are not a good idea. They are a good idea when understood and used correctly, and their component elements are understood as to how they will respond to market movements. I saw an instrument coming across my desk actually this morning where an organization has created a very unusual solution for a customer that has a cycle mode to it. And if X happens 3 times, then Y is the outcome. And you've got no control over that 3 times and where those 3 times happen. And I look at that and I think, depending on how you are managing, if you are in base metals, that might work based on the fact that you have certain auctions. So that might work. But if you're in a 90-day cycle of bringing in imported product that you're going to put into your manufacturing system, you don't want that kind of risk coming across your desk. You might as well not cover it all. So it's understanding those nuances. Banks and brokers all behave in very different ways. They do credit differently. They do credit utilization differently. They do the behavior of the instrument in different ways. And all of these have a cash flow impact. They have a credit line impact. And there are advantages of going outside of your main banking provider to look for foreign exchange solutions, leaving your core bank with the loans, the funding, the overdraft, and all the cash management facilities. Because the risk is if foreign exchange becomes extremely volatile. Time of Brexit, the sterling went from 144 all the way down to, I think it was 112. That kind of variety can actually wipe out your credit facility, and suddenly you don't have an overdraft and you can't run your business without that facility that the bank offers. So foreign exchange is one of the few things that actually pays to look at having your eggs in more than one basket and more than one provider, and a provider of different kinds, because you don't want to have a volatile market impacting you in one single way by every provider. So sometimes having different types of providers, again, create a natural hedge of protecting yourself against getting hurt of something you'd never thought of. So again, this is where we come in as the experts saying, be careful of A, B, and C if that is what you want to do, because it's going to impact your cash liquidity very directly. The other aspect you want to look at is we are human. We have ways of behaving. We are biased and we get influenced very easily by hype, by noise, by what's being said about a trend, and everybody's moving in the same way, and suddenly you feel like you're the one left out. We do respond to all these bias signals, and one of the things that we work really hard at is to make business forex decisions not in a time of noise, crisis, volatility, and activities. So if we know Bank of England were coming out with an interest rate decision today, we made those business decisions for our customers in the last week. We did not make the decision in the crisis of the moment we heard about it. So we had prepared our customers if there was no interest rate change, how could the market have responded positively, negatively? If it happens, positively or negative, we have 4 answers. So for my customer, I don't want to then end up with 4 answers noise occurring. What we are looking for instead is having a planned strategy. If one of those 4 things happen, we want to take advantage of it. We do not wish to panic. So the advantage strategy is put in place in advance of the event happening. So those are the kind of things we do to take out the behavioral science, out the panic. You could just imagine somebody in the finance department coming and finding the finance director and saying, big panic, there hasn't been a move in the interest rate. This is going to impact us negatively because the spot rate has moved so many points. What are we going to do? And they're going to go into panic mode thinking, well, what's my exposure? What's my risk? What's the decision I need to make? Invariably, the wrong decision then is made, purely because of the panic status that we have got the circumstances into. So in the case of our next stage, so we've now found out how we behave as people, where we can get the information from, and what we are responding to as data from within our organization. The next element is to look at that decision-making process that I talked about a moment ago. So it's the internal dimension of bringing together everything we've just spoken about very quickly in a very short period of time. I have all this information to my fingertips, which in most companies' cases is almost impossible. How do I get that information to my fingertips that my decision-making is absolutely seamless, logical, planned, and structured? I've made strategic decisions at the top of my finance tree. We've delegated the activity and actions to occur, and I've taken the panic out. I've determined when exceptions occur, unexpected opportunities are there. I've put in the strategy, they will kick in. They will immediately occur. And I don't have to think, oh, how much do I need to buy? What price should I buy it at? Why should I buy? Which currency pair should I be looking at? And the minute you get into that panic, you buy too much, too little, too quickly, too late. All of those things happen time and time and time again. So it's making sure that we have that information, it's absorbed and known by your treasury person, that we've got that data, that we can make strategic planning decisions every day, all the time we need to make them, but not in the panic mode. The reason I say we're making decisions all the time is daily, weekly, once a month, whenever we do it within our uniqueness of our business, we're going to have to buy and sell foreign exchange. And there are many ways of structuring it, that we can do it in routine processes, or we're doing it daily, or we're centralizing it. There's lots of ways of managing that noise in itself and that use of time and resources. At that point in time, we need to make sure that when we need to make a payment or receipt funds and convert it into home currency, that last moment of the foreign exchange process, from a decision point of view, that is the decision. I have got a choice right now that I need to convert euros into sterling, and I have got a number of choices of how I'm going to do it because I've got a portfolio. So I interrogate that portfolio every single time there's a payment or receipt, new orders, new hedging instruments, delays, credit notes, you name it. We're constantly making decisions and making sure that we've got that information to the people who need to make the forex decisions. So who needs to make the debtors decisions, creditors decisions, customer pricing decisions, competitor if we are looking at the business and we're now looking at new products, how do we look at new products compared with our competitor if we don't understand our forex strategy? So again, we've got to make sure that the internal information flows within the business and making sure that the people in the various elements, that the reporting and the information comes up. Not all the noise, just the critical decision-making elements rise to the top in the business so that the risk management and risk oversight and risk mitigation can be reported to board through the finance area of the business, through the customer, product and accounting and manufacturing part of the business, so that we are actually doing what is right to keep P&L profit on the bottom line and not waste it in these myriad of places you could be throwing money away. So now what are we going to do differently? What's new now that we have got this Valufin framework of information on which we're going to build our foreign exchange? What are we going to do with this new knowledge and new understanding of risk within our business? So we need to make sure we've got ways of getting that information, and we've got to make sure we've got methodologies for making decisions on information that flows from the external and the internal environment. And our objective here is quite simply stop throwing money away. Let's save the money. We're not in the business of being speculators in foreign exchange. What we are in the business for is protecting our business in a rational way so that we can be sure we're in business tomorrow, 5 years' time, and we are sustainable as a business because our forex processes are handled sustainably and most cost effectively we possibly can. A recent case study I'd like to just share with you is we had a customer that was dealing at spot with a number of currency pairs around the world, and their volatility of volume month on month was hugely volatile, very difficult for them to manage. And being a very big organization, things were structured within their departments to be handled by different people, step by step by step. So you end up with a lot of people in the chain internally that were involved in the foreign exchange processes. They had to put in the checks and balances for security, safety to the individuals, but safety to the bank account and money and how that was being used. And when we look back after a period of time and assessing a change strategy, just on the rate we were able to achieve for the customer, we were gaining, depending on the different currency pairs we were getting, is between 3 and 5% improvement just in the rate. Now, a lot of people in the foreign exchange world offer you services that will purely do that. They will get you better rates than you can get for yourself. So the most important thing is saying, if you look at foreign exchange strategy overall, that is just one element of the many things that you can do to keep money on the bottom line. We then moved to a situation of being able to have strategies to improve the currency hedging in place, that we're not relying on the spot rate on a given day at a given time, so that the bank got to know the pattern and we're then adding further margins. So take the ability to be second guessed by your provider and for them to effectively front run what you're going to do, and you end up getting the worst rate of the equation. So in the circumstance of this customer, we were seeing markets moving by well more than 5% volatility between our peaks and troughs of the market. And we're able to put that 5% onto the bottom line in very small, frequent transactions in a very well-planned strategy, that when they needed cover, they had good cover available, but not 100%. So if the markets are good, you still have opportunity to pick up better rates now, or to draw out of your portfolio that is sitting in the future, because it's also better than now. So there's lots of strategies that you can use. And that, in that case, we looked at the customer putting about 5% of 40% of the annual volume onto the bottom line. Utilizing spot versus cover, the opportunity management I mentioned earlier, we looked at when we analyzed, it was 2.5%. Interest rate strategies, which is absolutely wonderful in the last few years, where we've had declining and rising interest rates, now back into a declining mode. When interest rates move, there are very stable 1 to 2% margins that can be made. When interest rates are not moving, this line item will be negligible. Not zero, but it'll be less than 1%. The annual savings for this company, when those elements were all put together, was 5.95%, is what they saved on their annual turnover of foreign exchange. That is a big number that went straight to the bottom line. The thing that you have as a complexity in businesses is where can I see that 5%? Where's it standing out? It doesn't stand out anywhere. Where's the cost that you are alluding to? It doesn't stand out anywhere. We're just less efficient. We make less gross margin. We are not as competitive in the market. Our pricing is not as good to our customers. We're ending up with more people in the resource team than we need. Those are where the costs are. They don't sit out and say, I'm a forex cost, I'm a forex loss. It doesn't sit there. It doesn't sit there, I'm saying a forex profit. It's a saving of money that comes through in many ways. And one of the things we are able to do for our customers is to quantify how the strategy has saved them money, and then say to them, have you noticed certain changes within your business at this point? So to bring us towards the end of our session so that we can leave some time for questions, just to summarize our mnemonic and our framework, Valufin, for efficient foreign exchange management, is making sure that we understand our strategies, we understand our business, we learn how foreign exchange and importing and exporting impacts all the elements of our business. Every single element of our business is impacted. That we understand what the flows of money are going to be as a result of either the business or the market or our strategies, and they all impact us on cash flow. having a look at how we put a portfolio together. What is our risk appetite? How are we going to make these decisions? What are the kinds of structures we're going to put together? And do we know what they might do if we stress test them on a 5% move one way or a 5% move the other way? And companies so often don't do that stress testing process, which we will cover in more detail if we do any of the, we're going to have a book here, so you can read the book one day. The other element is just understanding, have you thought of all the correct stress tests? And this is where your risk committee, if you're a larger company, or your CEO or finance director should be thinking, what do I need to stress test happening? And one of it might be a COVID environment where the customer market disappears. What happens if the customer market disappears? Do we just evaporate our contracts? No, we can't. So what assets do we have? What risks do we have? What liabilities do we have? Internal decision-making processes, who needs what information to make sure that we are seamlessly doing the right thing for our business to be sustainable long-term. And then as a result of that, how are we doing things differently as a business from what we were doing it before? And you probably find any business where you're going to take this on yourselves, you will be doing this in an iterative process, doing one improvement at a time as you work through the framework. So going back to one of our earlier diagrams, and summarizing what we've talked about, our influences are the market, the company and its uniqueness and its behavior. The global influences, geopolitical, supply chain, customers, source of product, cost of resources, market behavior, market availability, all of those things. And then knowledge that we've brought into the business that we've pulled together through the framework such that we can manage our foreign exchange effectively. So these four components interact with each other all the time to give us efficient forex management. So lastly, the interconnectivity that we spoke about right at the beginning also has an interconnectivity to the instruments available and the forex components that are out there in the marketplace. So we have the spot rate. Most people are aware of that. We have interest rates, which people don't realize have a direct impact on the cost of what you're doing in the foreign exchange world. We have a time element to an instrument, whether it's immediately I'm dealing now, I'm dealing Tom, I'm dealing spot 2 business days, or I'm dealing at any period beyond that. As I mentioned earlier, anything up to 15 years. But most commonly, we see people operating within a season. And if you're in certain product ranges, your season might be a quarter of a year if you're looking at base commodities. But if you're looking at fashion, for example, you have an 18-month cycle from development to sales to customer. So all businesses have very different cycles. And if you're in agriculture, for example, you have an on-season in one year and an off-season in the same year. And is your product something that has a shelf life or doesn't have a shelf life? And then you have the various ways of packaging time, interest rate, and spot into a usable instrument that is meaningful to you and not harmful to you. And then you've got who's going to give you that, and all those providers that you're going to look to give you the various solutions, and no one will give you the same solution. They'll all be very different. Their credit terms are different, their margins are different, their way of pricing it is different, and it's making sure you can get to the best provider that makes sense to you as a business. I have now gone through a very, very, very fast process of dealing with the various many elements of foreign exchange. So I am open to questions if any have come forward